Okay, let's unpack this. That moment the stock market news hits. Right. Your phone buzzes, your portfolio's doing its thing, up, down, sideways,
Uh-huh.
and instantly your mind races. Buy, sell, or just pretend you didn't see anything. If you got investments, you know exactly what I'm talking about.
Definitely. It's a universal feeling for investors.
Today, we're diving deep into navigating these very market fluctuations.
What's really interesting is how these core questions have, well, stood the test of time. We're turning to a true cornerstone, Benjamin Graham's The Investor and Market Fluctuations, specifically Chapter 8.
Right.
Think of this as your personal framework for understanding and responding to the market swings without getting, caught in the emotional whirlwind.
Absolutely. This isn't about chasing the latest fad or trying to time the impossible. It's about building a strong, rational approach
Yeah.
to how you, our listeners, should fundamentally view the ups and downs of the market.
And to bring a contemporary perspective to Graham's enduring wisdom, we're also looking at commentary from Jason Zweig.
Good point. Zweig's great.
He really helps us connect these ideas to today's realities, especially that brilliant Mr. Market concept.
Oh, yeah, Mr. Market. Classic.
And why individual investors might actually have some surprising advantages.
So, if we step back and look at the bigger picture, our goal for you in this deep dive is clear.
Uh-huh.
By the end, you'll have a much firmer grasp on market volatility. You'll see it less as a constant threat and more as a landscape an investor can navigate thoughtfully, always keeping your long-term objectives in focus.
Exactly. Less fear, more framework.
So let's get straight to it. One of the first things Graham emphasizes is the sheer inevitability of market fluctuations.
Right off the bat.
He points out that while short-term, high-quality bonds tend to be relatively stable, longer-term bonds, and especially common stocks, are simply going to experience price swings. It's just part of their nature.
And this brings up a crucial point for you, the listener. Are you truly prepared, both financially and importantly psychologically, for this reality?
That's key, the psychological part.
Graham stresses that this isn't a mere possibility, it's a near certainty. And it taps into a very human tendency, the desire to try and profit from these very changes.
And that's where things can get tricky, isn't it? The line between making informed investments and just, well, speculating can become blurred.
Very easily. Graham is very clear here. Speculating has a high likelihood of losing you money over the long haul.
Right.
If you choose to engage in it, that's one thing, but he strongly advises keeping it separate and limiting the risk, distinct from your core investment strategy.
Okay, so keep investing and speculating in separate boxes, mentally and financially.
Pretty much. Now, what's fascinating is his immediate shift to how a thoughtful investor can potentially benefit from these fluctuations. He lays out two primary approaches, timing and pricing.
Timing and pricing, okay.
Timing is all about trying to predict the market's direction, getting in before it goes up, getting out before it drops.
The crystal ball approach.
Kind of, yeah.
Yeah.
Pricing, on the other hand, is about buying when you believe a stock is undervalued and selling when it becomes overvalued.
And Graham is quite firm about which of these he champions for the intelligent investor, which of course includes you, our audience.
He is. He's convinced that by focusing on pricing, buying good businesses at sensible valuations, you can achieve perfectly satisfactory long-term results.
Satisfactory, not necessarily shooting the lights out every year, but solid long-term.
Exactly. Conversely, his skepticism regarding timing and market forecasting is equally strong. He essentially equates it to speculation and the inherent risks involved.
Makes sense.
He even makes this insightful observation that the further removed someone is from Wall Street's daily noise, the more skeptical they tend to be about the entire notion of accurately predicting market movements.
That makes a lot of sense, doesn't it? Think about it, we're constantly bombarded with market predictions. But how truly reliable can they be?
Well, yeah.
Graham poses a really fundamental question. If everyone rushes to sell based on some predicted downturn, who exactly is going to be there to buy?
Exactly. There's a basic logical flaw in the idea that the average investor can consistently outperform the market through forecasting. Everyone else is trying to do the same thing.
Right, with maybe more resources.
Often with more resources and potentially less emotional attachment. And Graham also touches on a key psychological aspect. Timing appeals to speculators looking for quick gains.
The thrill of the chase.
Maybe, but for a long-term investor, the act of waiting itself isn't a disadvantage unless it prevents you from eventually buying at a significantly more attractive price, which circles us right back to the principle of pricing.
Right. So for an investor, The value of anticipating market movements really only comes into play if it allows you to buy quality assets at a better price.
That's the crux of it.
It's not about the prediction itself, it's about the price you ultimately pay. And to really illustrate the dangers of relying on timing, Graham delves into the history of the Dow theory.
Ah, yes, the Dow theory. What's interesting to note is how it, generates buy and sell signals based on breakthroughs in major stock market averages. And it appeared remarkably successful for a significant period, from 1897 up into the early 1960s. It even famously issued a sell signal just before the devastating stock market crash of 1929.
Wow, okay. So it looked like it worked for a while.
For a while, yeah. But here's where it gets really interesting. Graham points out that after 1938, the Dow theory's effectiveness shifted dramatically.
How so?
Instead of reliably signaling exits before major declines, it often led investors to sell at reasonable prices, but then buy back in at even higher prices later on.
Ouch. So you sell, miss some upside, and then buy back higher. Not ideal.
Not at all. For nearly 3 decades, a simple buy and hold strategy focused on the Dow Jones Industrial Average would have actually yielded better results.
So just holding on would have been better than following the theory after 38.
That's what the data suggested. And this, according to Graham, wasn't just a streak of bad luck. He argues that it highlights a crucial characteristic of many popular forecasting and trading formulas in the financial world. When a particular method gains widespread popularity and appears to have worked well in the past, its reliability tends to erode over time.
Okay, let's unpack this. Why does that happen?
Graham suggests a couple of key reasons. First, the market is a constantly evolving environment. New economic conditions, tech shifts, changes in investor behavior.
Things change.
Right. They can render older formulas less relevant. Second, in the stock market, the very fact that a trading theory becomes widely known and followed can actually influence market behavior.
The self-fulfilling or self-defeating prophecy.
Exactly. It can undermine its own profitability. If a large number of investors act on the same signal, it can create artificial price movements that aren't sustainable.
Think of it like trying to find an edge in a poker game. If everyone knows your strategy,
your advantage disappears.
Right.
The stampede effect that Graham mentions is a real danger in the market. When too many people try to do the same thing at the same time based on the same signal, it often leads to disappointing outcomes.
So, if trying to time the market is generally not a winning strategy for the average investor, what about the more intuitive advice? Buy low, sell high.
Yeah, the classic maxim. Graham examines this approach, observing that prior to 1950, market fluctuations seemed to offer more consistent opportunities to follow this principle.
Okay, so it used to be maybe a bit simpler.
What's notable here is how Graham refers to the historical data, highlighting these seemingly regular patterns of bull and bear markets, with substantial percentage gains followed by significant declines. It appeared to be a relatively straightforward strategy: purchase after a major downturn, sell after a substantial upturn.
And he even mentions that a traditional definition of a shrewd investor was someone who did just that.
Exactly. Bought when pessimism was high, sold when optimism was, well, maybe too high. Various techniques were even developed to try and identify these ideal buying and selling points.
That's always a but.
Always. Graham cautions that even before the major bull market that began in 1949, the variations within those market cycles were significant enough to make this buy low, sell high approach quite complex and at times frustrating.
Like the 1920s.
The speculative new era cycle of the 1920s, for instance, presented a significant deviation from historical norms. It wasn't always clear-cut.
Right, so even before the post-World War II era, simply waiting for those deep bear market troughs to initiate buying wasn't a foolproof strategy.
No. Graham goes so far as to suggest that basing your entire investment policy on this classic formula today seems unrealistic given the market's evolving dynamics.
So what's the alternative then?
Instead, he proposes a more adaptive approach, adjusting the proportion of stocks to bonds in your portfolio.
Asset allocation.
Based on your own assessment of whether stock prices appear relatively attractive or unattractive in relation to their underlying value, rather than solely relying on broad market timing signals.
Got it. More about valuation, less about prediction. This leads us to the concept of formula plans. These gained traction, you said, in the early stages of the post-1949 market boom.
We did.
Could you explain the basic idea behind these plans for our listeners?
Essentially, these plans, going beyond simple dollar cost averaging.
which is just investing a fixed amount regularly.
Right. These formula plans involved having predetermined rules for automatically selling stocks when the market experienced significant upward movement.
So taking profits systematically.
Sort of. Some plans were quite aggressive, calling for the sale of all stock holdings after a very large market advance. Others were more moderate, maybe keeping a small core allocation to equities regardless.
And the appeal was understandable, right? They sounded logical, disciplined.
Very appealing. And when you looked back at historical market performance, these plans often appeared to have delivered excellent results. On paper.
Okay, so what was the catch?
Exactly. The critical issue, as Graham points out, is that their popularity peaked just as they were about to become significantly less effective.
Timing again. Bad timing.
You could say that. Many investors who adopted these formula plans in the mid-1950s found themselves largely or entirely out of the stock market during a substantial portion of its continued rise.
Oh, no.
With their preset rules offering very limited opportunities to reinvest at comparable prices, they essentially missed out on a considerable portion of the market's gains.
It's almost as if the widespread adoption of a strategy can alter the market conditions that initially made it successful.
That seems to be a recurring theme. Graham draws a parallel here to the mechanical application of the Dow theory, and even his own earlier central value method.
So the lesson is?
The underlying lesson seems to be that any investment approach that is easily described and widely followed as a simple path to riches in the stock market is likely too simplistic to maintain its effectiveness.
Easy money isn't usually easy or sustainable.
He even quotes Spinoza. All things excellent are as difficult as they are rare. It really underscores the idea that consistently outperforming the market isn't typically achieved through a simple, easily replicable formula.
Okay, so we understand that market fluctuations are inevitable, trying to time them is generally risky, and relying on simplistic formulas might not be the most effective approach. Right. How then should an individual investor actually think about these fluctuations in the context of their own investment portfolio?
Graham emphasizes that if you hold common stocks, you must anticipate that their value will fluctuate, often significantly, over periods of several years.
Expect volatility. Got it.
He uses the Dow Jones Industrial Average as an illustration, highlighting the considerable swings it has experienced over relatively short time frames. And while he notes that the prices of smaller, second-line companies might exhibit even greater volatility than those of major corporations, this doesn't necessarily mean they will underperform in the long run. Volatility isn't the same as long-term return.
Okay, so a key is accepting that a certain level of volatility is a normal part of investing in stocks. But how do we manage the psychological impact of these swings?
The psychology.
A substantial market rise can feel fantastic, but it can also breed anxiety. Is it a bubble? Should I take profits? Conversely, a significant downturn can be unsettling, but it might also present potential buying opportunities.
These are indeed the core psychological challenges that investors face. Graham points out that a considerable market advance is certainly a reason for satisfaction, but it should also prompt prudent concern.
Don't get too carried away by the party.
Exactly. It can tempt investors to become overly optimistic and make larger, potentially riskier commitments based on the prevailing bull market atmosphere.
FOMO kicks in, fear of missing out.
Right. While this might seem like an obvious pitfall when discussed rationally, even experienced investors can find it difficult to resist the collective enthusiasm of the market.
And it's precisely because of these emotional aspects of investing that Graham suggests considering some form of mechanical approach.
Like those formula plans, but maybe applied differently.
To adjusting your portfolio's asset allocation, specifically the balance between bonds and stocks. Having a preset plan can provide a disciplined framework for action when the market moves significantly.
Okay, so rebalancing. As the market rises and your stock holdings become a larger percentage of your portfolio, a formula could dictate selling some stocks and buying more bonds,
Bringing it back into balance.
thereby rebalancing back to your target allocation. Conversely, during market declines, you would automatically buy more stocks with the proceeds from your bond holdings.
Buying low, selling high, but systematically.
It provides a systematic way to manage risk and, as Graham notes, can offer a degree of satisfaction in acting contrary to the prevailing market sentiment. It encourages that valuable contrarian perspective.
Leaning against the wind, so to speak. Now, Graham then shifts his focus to how market fluctuations affect the investor's fundamental position as a part owner of businesses. He introduced the idea of a shareholder having a double status.
Yeah, this is interesting.
Could you elaborate on what he means by that?
Certainly. As a shareholder, you simultaneously hold two roles. First, you are a part owner of an underlying business,
The actual company.
where your long-term returns are ultimately tied to the company's profitability, its financial health, and the intrinsic value of its assets. Second, you possess a tradable stock certificate
The ticker symbol on the screen.
that can be bought and sold on the open market at a price that fluctuates based on a multitude of factors, including overall market sentiment, investor psychology, and short-term news.
And Graham argues that the success of many companies has paradoxically led investors to become increasingly reliant on those fluctuating market prices, right?
Yes, exactly.
Because the market value of these successful companies often far exceeds the tangible value of their underlying assets, the book value.
Precisely. When you pay a significant premium above a company's book value, the accounting value of its assets minus its liabilities, you are essentially placing your faith in the stock market's ongoing validation of that higher price.
Trusting the market's judgment.
And this is where a really interesting dynamic emerges. Graham identifies a sort of built-in contradiction.
Okay.
The more promising a company's future prospects appear, the less its current share price tends to be anchored to its book value. However, the greater the divergence between the market price and the underlying asset value, the more the stock's value in the short term becomes dependent on market sentiment,
So it floats more freely.
leading to potentially greater price volatility.
So somewhat counterintuitively, higher quality, growth-oriented stocks can actually exhibit more speculative price behavior than the stocks of more established, perhaps slower-growing companies that trade closer to their asset value.
It seems that way sometimes. He even provides examples like IBM and Xerox, which experienced substantial price declines despite their strong long-term growth potential at the time.
Right. Big names, big drops.
This observation leads Graham to a very practical piece of advice for the conservative investor.
Yeah, what should they do? Consider focusing on stocks that are selling at a reasonable price relative to their tangible asset value. Perhaps not more than 1/3 above that figure.
Okay, look for things closer to book value, basically. His reasoning is that purchases made at these levels offer a more direct connection to the company's balance sheet and a degree of fundamental support that is less susceptible to the shifting winds of market sentiment.
A bit more of an anchor. But he also includes a critical caveat, doesn't he?
Oh, definitely. But just because a stock is trading at a low price relative to its assets doesn't automatically qualify it as a sound investment. You can't just buy cheap stuff blindly.
Value traps exist.
Exactly. Graham stresses that even when a stock appears cheap based on its asset value, you must also look for other important characteristics of a sound investment.
Such as?
This includes a satisfactory earnings-to-price ratio, indicating sufficient profits relative to price, a strong overall financial position, and a reasonable expectation that its earnings power will be maintained in the future.
So cheap, profitable, financially sound, and likely to stay that way.
That's the ideal combination. While it might seem challenging to find all these criteria in a modestly priced stock, Graham argues that it is indeed possible in most market environments that aren't, excessively overvalued.
And for investors who do own stocks that meet these criteria, trading reasonably close to asset value, sound financials.
What's the payoff?
Graham suggests they can afford to adopt a much more detached perspective regarding short-term market fluctuations.
The Zen investor.
Sort of. As long as the company's fundamental earning power remains healthy and its financial position solid, there's no compelling reason to be overly concerned with the daily noise of the market.
Makes sense. Focus on the business, not the ticker.
In fact, significant market downturns can even present potential opportunities to increase your holdings in these fundamentally sound companies at even more attractive prices.
Turning volatility into an advantage.
To really illustrate these principles in action, Graham presents a compelling historical case study, the Great Atlantic and Pacific Tea Company, commonly known as A&P.
The A&P story, a classic.
Could you walk us through the key points of that story?
Sure. The historical trajectory of A&P's share price provides a powerful example of market extremes. In 1929, during the height of the speculative boom, it traded as high as $494.
Peak bubble price.
Then, by 1938, in the midst of the Great Depression, it had plummeted to a low of 36.
Wow, huge drop.
What was particularly striking at that low valuation of $126 million was that the company held $85 million in cash alone.
Just cash.
And $134 million in net current assets, meaning the value of their liquid assets like cash and receivables minus short-term liabilities.
So worth more dead than alive, almost.
Essentially, even after paying off immediate debts, they'd still have substantial, readily available funds. This was the largest retailer in America, consistently profitable, yet the market valued it at less than its liquid assets.
That's an incredible disconnect. So what factors led to such a significant undervaluation?
Several factors likely contributed. Anxieties surrounding new taxes being considered for chain stores, a temporary dip in the company's profitability, and the overall severely depressed state of the broader market.
A perfect storm of negativity.
Pretty much. However, Graham points out that the tax concerns proved to be largely overblown, and the other issues were relatively short-term in nature. The market, in this instance, was clearly making a significant misjudgment of the company's intrinsic worth.
So the market panicked. And what was the subsequent outcome?
The following year, A&P's stock price rebounded dramatically, more than tripling from its 1938 low.
Big bounce back.
And then in the extended bull market that followed World War II, it continued its upward climb, eventually reaching the equivalent of $705 for the 1938 shares in 1961.
Incredible run, but
here's where we see the opposite extreme. That 1961 peak price represented a price-to-earnings ratio of 30.
pretty rich valuation.
Which was not supported by the company's historical earnings growth and ultimately proved unsustainable. The company's performance subsequently declined, and the stock price followed suit, eventually falling to new lows even after reporting its first-ever quarterly loss.
Wow. So a company that was arguably being given away in 1938 became wildly overvalued in 1961 and then experienced a significant decline.
A full cycle of market folly.
What are the key lessons we can draw from the A&P story?
Graham highlights two crucial takeaways. First, the stock market can be demonstrably wrong, creating significant opportunities for investors who are both observant and have the conviction to act.
When prices get crazy, low, or high.
When prices deviate significantly from underlying value. Second, businesses themselves evolve over time, sometimes for the better, often for the worse.
Things change.
Underscoring the importance for investors to periodically reevaluate their holdings rather than simply buying and forgetting.
No buy and forget forever. Okay. This brings us back to the distinction between owning publicly traded shares and holding an interest in a private business. Graham makes a really important observation about the pressure to sell.
Yes. This is fundamental. The true long-term investor is rarely under any actual compulsion to sell their shares.
You're not forced to.
And always have the option to disregard the daily fluctuations in price quotations. You only need to pay close attention and take action when market conditions align with your own well-defined investment objectives.
So you control when you act.
Allowing yourself to be panicked into selling during unwarranted market downturns transforms your inherent advantage, the ability to hold patiently, into a significant disadvantage.
Turning your strength into a weakness. He even offers a thought-provoking scenario.
The private business owner.
Yeah, imagine individuals who owned stakes in private businesses during the Great Depression. They likely wouldn't have felt the same intense pressure and fear simply because there were no daily market prices flashing red.
Right, no constant feedback loop of fear.
Even if the underlying economic conditions were impacting their businesses.
It's a powerful reminder that while daily market quotes provide liquidity, offering the option to buy or sell easily, they don't dictate your investment strategy unless you allow them to.
Liquidity is an option, not an obligation.
You have the freedom to base your assessment of value on more fundamental factors related to the underlying businesses you own.
And this is where the renowned Mr. Market parable comes into play. Could you explain this crucial analogy for our listeners?
Ah, Mr. Market.
Yeah.
My favorite. Imagine you have a silent business partner named Mr. Market.
Okay.
Every single day, without fail, he comes to you offering to either buy your share of the business or sell you more, quoting you a price.
Daily offers.
Sometimes his valuation seems quite reasonable, reflecting the actual performance and prospects of the business. But on other days, Mr. Market's moods swing wildly.
Moody partner.
Very. He might become irrationally exuberant and offer you a ridiculously high price, or he might become deeply pessimistic and quote you an absurdly low one.
So the key insight is that as a thoughtful investor, you shouldn't allow Mr. Market's daily, often irrational pronouncements to dictate your own assessment of the business's true worth. Right.
Precisely. You are under no obligation to trade with him. You should only transact with him when his offered prices are genuinely advantageous to you.
Take advantage when he's being irrational in your favor.
Exactly. The rest of the time, you are far better off forming your own independent judgment of the business's value based on its fundamentals, its financial health, competitive position, long-term prospects.
Focus on the business reality, not his mood swings.
This is precisely the position of someone who owns publicly traded common stocks. You have the option to either take advantage of those daily price offers or to completely ignore them based on your own informed opinion.
Use the quotes for your convenience, not let them control you. And those market signals, those sudden price drops, aren't necessarily reliable warnings that you should sell, are they?
No, not automatically. For the true long-term investor, significant price fluctuations primarily represent potential opportunities.
Opportunity knocking.
Opportunities to buy wisely when prices decline substantially and to sell wisely when they rise considerably above your assessment of intrinsic value. Otherwise, your focus should remain on the dividends the company pays and its underlying operating performance.
Watch the business fundamentals. So, to clearly differentiate, how does Graham define the fundamental difference between an investor and a speculator in their attitude towards market movements?
The speculator's primary objective is to forecast and profit from short-term market swings, predicting the wiggles.
Right.
The investor, in contrast, focuses on acquiring and holding suitable securities representing ownership in real businesses at sensible prices that offer a margin of safety.
Buying businesses, not just trading stocks.
Market movements are practically important to the investor, primarily because they occasionally create those attractive buying and selling opportunities we just talked about.
They create the entry and sometimes exit points. But he also advises against waiting indefinitely for those absolute bottom of the market prices to begin buying, doesn't he?
Yes, that's crucial. Remaining completely on the sidelines, waiting for some perfect market bottom that may never materialize, can lead to both lost potential income and missed opportunities to acquire valuable assets at reasonable prices.
Paralysis by analysis, waiting for the perfect moment.
Exactly. Graham advocates for a more pragmatic approach, generally investing in stocks when you have funds available, except in periods when the overall market appears to be unjustifiably high.
Good.
And always remaining vigilant for individual companies that represent compelling value.
So invest when you can, unless things look crazy expensive, and always look for bargains.
And what about the temptation to try and pick the next high-flying stock or to consistently beat the market in the short term?
Yeah, the siren song of alpha. Graham seems quite skeptical of that pursuit for the average investor.
Why is that?
He is indeed. He believes that attempting to predict which specific stocks will outperform in the short run is an exceedingly difficult game, particularly when you are competing against a vast number of highly sophisticated professionals.
With access to extensive resources and information. In an environment where numerous intelligent and well-informed individuals are constantly trying to anticipate short-term price movements, their efforts tend to largely offset each other. It's hard to have an edge.
A zero-sum game in the short term, maybe.
Something like that. So the investor who has constructed a well-thought-out portfolio should really just anticipate these inevitable price fluctuations and avoid becoming overly concerned by temporary declines or excessively excited by short-term advances.
Keep calm and carry on investing.
Precisely. Remember Graham's core principle. Never buy a stock simply because its price has recently risen significantly, and never sell a stock solely because its price has recently fallen substantially.
Don't chase momentum up or panic sell down.
Or, to put it even more succinctly, avoid buying immediately after a substantial price surge and avoid selling immediately after a significant price drop. Let the dust settle.
Graham also raises an interesting additional point regarding the connection between average market prices and the competence of a company's management.
Yes, this is a bit more philosophical, perhaps. He posits that just as shareholders logically evaluate the success of their investments based on dividends and long-term market value.
Right, the results.
These same criteria should, in principle, be used to assess the effectiveness of a company's management team.
So the stock price, over time, reflects management quality.
Good management, he argues, tends to generate good average market prices over the long term, and conversely, persistently poor market performance might be indicative of underlying management issues, though he adds caveats about market fluctuations unrelated to fundamentals.
Interesting angle. Now, we spent a good amount of time discussing the fluctuations in the stock market, but Graham also addresses the price volatility of bonds, doesn't he?
Yes, absolutely. Even though high-grade long-term bonds are generally considered relatively safe in terms of repayment of principal and interest,
The safe part of the portfolio.
their market prices can still experience significant fluctuations due to changes in prevailing interest rates. There's that fundamental inverse relationship.
Rates go up, bond prices go down.
When interest rates rise, the market prices of existing bonds tend to fall, and when interest rates decline, bond prices typically rise.
And he uses historical examples to illustrate this volatility, even in bonds that were considered very stable investments back then.
Exactly. He highlights considerable price swings over several decades in bonds like the Atchison, Topeka, and Santa Fe General Mortgage 4s and the Northern Pacific Railway 3s.
Names from the past.
And he points out that even within the high-grade bond market, there have been unprecedented movements in both directions since the mid-1960s. The key takeaway here is that historical patterns observed in bond markets are not reliable predictors of future price movements.
The past isn't always prologue, especially with interest rates. So if trying to forecast stock prices is challenging.
Predicting bond price movements is perhaps even more so, it sounds like. That is certainly Graham's perspective.
So what should bond investors do?
He suggests that your decisions regarding bond investments, such as choosing between long-term and short-term maturities, should primarily be guided by your own individual preferences regarding risk and your anticipated future interest rate outlook.
Personal preference matters.
U.S. savings bonds, he notes, offer a particularly stable and predictable option. And for those investing in longer-term corporate or municipal bonds, it's crucial to be prepared for potential price fluctuations in the secondary market. Don't assume stability means no price change.
He also mentions the practice among institutional investors of valuing high-rated bonds at amortized cost, essentially ignoring interim market price changes.
Yeah, that's an interesting perspective for individual investors to consider.
How so?
It is. It encourages taking a long-term view and not being overly preoccupied with short-term market price volatility, particularly if the underlying creditworthiness of the bond issuer remains strong. Focus on getting your principal and interest back, not the daily price.
Got it. He also briefly touches on convertible bonds and preferred stocks.
Right, noting that their prices are influenced by a combination of factors, the related common stock price, interest rates, credit standing, which can lead to even greater price volatility sometimes. More moving parts.
Finally, let's bring in Jason Zweig's commentary, which provides a valuable contemporary lens
Yeah, Zweig's commentary is fantastic.
through which to view Graham's timeless insights, particularly his concept of Mr. Market.
Zweig emphasizes that Graham's assertion that the investor is at liberty to either exploit or ignore daily market quotations might very well be the single most important sentence ever written about investing.
High praise.
It truly underscores the fundamental power and freedom that individual investors possess. You don't have to listen to the market noise.
And he brilliantly expands upon the Mr. Market metaphor, portraying the stock market as this incredibly temperamental and often irrational business partner.
Exactly. Mr. Market's daily offers to buy or sell are driven by his ever-shifting emotions: fear, greed, euphoria, despair, not necessarily by any rational assessment of the intrinsic value of your investments.
He's bipolar, basically.
You could say that. Zweig's core message is that you should never allow Mr. Market's volatile moods to dictate your own perception of value or to pressure you into making impulsive trades.
Don't let him infect you with his mood.
Engaging with him is always an option, never an obligation. Remember that.
And Zweig does a fantastic job of contrasting individual investors with large institutional investors, highlighting the often overlooked advantages that you, the individual listener, actually have.
What's so insightful is how he flips the conventional wisdom. While institutions once held significant advantages in information, maybe, today their sheer size, the constant pressure to demonstrate short-term performance, and the demands of managing large client bases can actually create significant disadvantages.
They have constraints we don't.
Exactly. You as an individual possess the nimbleness, the capacity to focus on long-term goals without the constraints of quarterly reporting, and the freedom to invest in less popular or overlooked companies without the limitations of scale. You can buy things they can't or won't.
He even refers to the ability of individual investors to invest with a truly long-term horizon in a short-term obsessed world as a genuine superpower.
That really resonates, doesn't it? It's your edge.
It does. And Zweig's cautions against allowing Mr. Market's constant noise to lead to conformity and the erosion of your own independent judgment.
Herd behavior. It feels safer, but is often dangerous.
He stresses the crucial distinction between having options as an investor and feeling compelled to react constantly to the market's every whim. He even uses the powerful image of the investor as a guardian of the future against the claims of the present.
Wow, that's deep. Protecting your future self from your present self's panic.
And in our increasingly interconnected world, Zweig argues that technology has, in some ways, amplified Mr. Market's volatility,
Oh, definitely.
pointing to the meme stock frenzies as vivid examples of how collective attention can drive irrational market behavior.
Absolutely. Those rapid and often inexplicable surges and crashes in meme stocks vividly illustrate the emotional turbulence that Mr. Market's mood swings can create. Technology makes the mood swings faster and maybe more extreme.
And Zweig details how emotions, such as anger, anxiety, loneliness, sadness, and stress, can significantly cloud your judgment.
And lead to suboptimal investment decisions. Trading while emotional is usually a bad idea.
So what practical advice does Zweig offer for effectively dealing with Mr. Market, particularly during those inevitable market downturns or even unexpected surges?
He suggests talking back to Mr. Market, basically creating mental distance.
Now,
When confronted with extreme market movements, take a deliberate step back. Try to imagine you are offering advice to someone else that helps remove the emotion and carefully consider fundamental questions
like,
about the businesses you own, the potential tax implications of selling, and whether your original long-term investment thesis has genuinely changed. Has the business fundamentally altered, or is it just the price?
it's about anchoring your decisions in underlying value rather than simply reacting to short-term price fluctuations.
Precisely. Don't let the price tail wag the fundamental dog.
So as we bring this deep dive to a close, what is the most important takeaway you want our listener to remember about navigating the inevitable ups and downs of the market?
The most crucial insight, I think, is that market fluctuations are not only unavoidable, but can actually present valuable opportunities for patient and rational investors.
Volatility is opportunity, potentially.
However, reacting emotionally or attempting to predict the market's next move are generally counterproductive endeavors. The real power lies in cultivating independent thinking and maintaining a steadfast focus on the underlying value of your investments.
Back to basics.
Precisely as Graham originally outlined and Zweig so effectively reinforces for today's investor.
And some actionable advice for you, our listener. Take some time to thoughtfully reflect on your own investment approach in light of the enduring wisdom of Graham and the contemporary insights of Zweig.
Do a self-check.
Re-examine your portfolio. Not just looking at the current prices, but striving to understand the intrinsic value of the businesses you hold. And the next time the market experiences a significant swing, remember that vivid image of Mr. Market.
Is he manic or depressed today?
And carefully consider whether his offer truly aligns with your long-term financial well-being.
And here's a final thought to consider. Reflecting on the historical examples we've discussed today, like A and P, what might be some modern-day A and P scenarios that you could be overlooking?
Where's the big disconnect today?
Where might current market perception be significantly diverging from underlying business value, potentially creating compelling long-term opportunities or maybe significant risks? Food for thought.
This has been a truly enlightening exploration into understanding and navigating market fluctuations. It's a foundational aspect of successful long-term investing.
Absolutely fundamental.
And we'll certainly be delving into related concepts in future deep dives to continue building your investment knowledge. Thanks for joining us.
My pleasure.